Welcome back to the channel. I want to first of all say thank you to everyone for their kind words. I got a lot of emails, a lot of support while I was going through a bout with COVID. Took me about 9 days to get over. And I want to get caught up on everything that I wasn't able to get caught up with you during those 10, 12 days I did not do any videos. So today's video, we're going to get caught up on everything going on right now that you see going on in the stock market, why that the stock market is going up as interest rates are going up. Why is that, and where are things going? Now let's remember, this is advice, folks. This is based on factual information that I research. I am not a consultant. I'm not a finance advisor. I'm just showing it to you from the perspective of someone that reads every day. Now, what I want to really start with is, first of all, while I was sick, the Fed raised the interest rates another 3/4 of a point. And in reaction, the stock market went up. In fact, as of today, when I last looked, it was north of 32,500 on the Dow Jones Industrial Average. Now you're probably wondering, why is that possible? Well, you got to look at the companies they're actually investing in, okay? One of the major things that people are starting to realize is the stock market has gotten cheaper. So you're getting investors right now. Investors are taking advantage of the low prices that we're getting into. So for example, I've been buying AT&T at $18.34 up to $18.74. Okay? And the reason why is that's a bargain price. It went down from $21 when I was originally starting to buy it, and it was going down from there after they announced that they didn't make a lot of money. So why do I keep buying? Because that is a utility company, cell phone, TV, streamer, things of that nature. And what's happening is that they're going to lower in price and stay around this range, but eventually that price is going to go back up. So it's a bargain. So right now you're seeing a lot of investors that have extra cash. They're going, you know what? I can get into a dividend paying stock at a bargain price. As you guys know, I like using the whiteboard, especially when I'm doing all this. But the Fed raised the rate, and who does it hurt? Well, these are the industries it's going to hurt the hardest. So these are the two industries that are going to get hit the hardest by this interest rate raise. So right now, trucks and cars, especially in the used market, the values are going down because interest rates are going up. Why? Because banks, watch this, guys. This is the important part. Pay attention to this. It has nothing to do with supply or demand. It has to do with basic financing, okay? So a bank has something called payment to income. Payment to income. So the reason why cars and trucks are dropping in price, the reason why the used market is getting all screwed up, is because payment to income. Okay? So let's say a person on average makes $3,000 a month. Normal banks want you to only have a 15% PTI, which means they want you to have no more than a $450 a month payment. So can you buy an $80,000 truck for $450 a month? No. Can you buy a $45,000 used car for $450 a month? No, it doesn't pencil out, right? So interest rates have gone up. So for us to continue to move cars, for dealerships to continue to move inventory of any kind, they have to drop their prices to accommodate for the hike in interest rate. Okay, so forget supply and demand. any salesperson about supply and demand, yeah, they're not telling you the whole story. So let's talk about supply. Okay, supply on new trucks is very low, but the trucks are on a dealer's lot, and I covered this in my last video. New inventory still costs the dealership money to floor it or to keep it on its inventory. So they have to move the inventory to keep the cash flow, to keep the bills low, so they can have some sort of pocket money when they're done. You don't go into business to lose money. You go in business to make money. And these last 2 years, okay, have been what we call an aberration. This never happens. What occurred was such a phenomenon that we, the consumer, think the world's crashing. No, it's correcting. So that's what the Fed's interest rate hike is meant to do, is to lower the prices of our needs, which are car, truck, housing, to where it becomes affordable. Does it work every single time? Is it going to work this time? Well, it's just starting to work in the used car market, because used car prices are plummeting compared to what their average was during the aberration. They actually are depreciating. All right, let's look at how housing is going to be affected. Okay, there's going to be one of 3 ways this is going to go. Okay, this is my prediction. This doesn't mean, this is based on factual information. This is not based on a guess. This is a theory, I guess we could call it, based on facts that I gathered and read. Okay, number 1 is housing is going to go down 20 to 22% in 2 years. You're probably wondering, why 2 years? Well, the reason why I've been saying 2 years on my TikTok channel and YouTube and everything else is because in 2 years, that's how long it'll take for the demand to catch up to the supply. It's not like the car business or the RV business or the boat business where everything is affected right away. You know, used car prices plummeted. RV prices have gone down because dealerships know they have to stay in business and keep cash flow. To keep a house on the market costs no money. So for Zillow, for any realtor, it doesn't cost them any money. They don't have to borrow money from a bank to list a property. Okay? So to list a property, you just need to list the property from the owner. It's free. So it costs nobody anything. Except for the owner of the home, it costs them their mortgage payment every month. So unless you have some kind of fee you charge to list your house, which would be crazy these days, it is free inventory. It's like if I came over and gave you a bunch of 1960s comics that were in excellent shape and said, here, sell them on your own. Just give me the money after you sell them. Just give me my profit after you sell them. It didn't cost you anything. They just gave it to you. Here you go. So how long are you going to hold on to those prices? You're going to hold on to them as long as humanly possible until the owner of the comics, or in this case, the owner of the real estate, starts going, hey man, we need to start dropping the price. I want to sell my house. That's going to take some time. People have some patience about it, okay? So rates won't really start affecting the housing market for about 2 years. So I'm going to predict probably the start of it would be August, September of 2024 is when we're going to start seeing housing drop 20 to 22% in appraised value. Because now you're going to start seeing some of these homes come on the market that went from being a $600,000 home to like, you know what, I'm willing to take $480,000 at this point because that's what I owe on my house. we're trying to move out of California, we're trying to move out of Texas, we're trying to move out of Oklahoma, whatever the case may be, that's where that's going to occur. The second thing that's going to happen, and this is a theory, okay, it's going to be, we're going to call them hedge funds. Hedge funds bought a bunch of properties cash, okay? They didn't borrow money to buy these single family homes. They paid cash for them. Now, there's ways that they can leverage their money and leverage their investments. There's all kinds of ways that very rich people try to avoid taxes, okay? But that doesn't mean that they don't have a bunch of cash tied up in these homes, okay? So the last circa, when I left my TikTok live, the last time I looked, it was 3.741 million vacant rentals. This does not include Airbnb. None of those. Does not include that. This is vacant rental properties. These are properties that were bought by investors. These were single family homes bought by investors, way over appraised value, okay? And they have rentals. And the rental, they can't rent them. So it's cheaper in their mind to not lower the price of the rent because of three words, NOI. Net on investment. It doesn't make sense. So they'd rather leave the property vacant, leave the house vacant, and then what they do is they write off the loss on their taxes. Because it doesn't cost them anything. They paid cash for the house. They paid cash for the townhome. They paid cash for the duplex. Why should they rent it out for anything less than what they determine the NOI is? Okay. Now, here's how that kind of works. Let's switch to red here. Okay. Red pen. Here we go. So, what did that mean? That meant, let's say a guy in Florida sold his house for $200,000 above appraisal. Lots of stories about that. Okay. So now let's just say that the average rental property before they paid that was $1,800. For them to make up the difference, they have to get 8% of this. That's the math. Now, I'm not going to go big into the math. If you want the math, I'll put Grant Cardone's university and real estate links in the description box below. And, you can kind of go over the math of his math, Warren Buffett's math. At the end, everybody has this agreement. It's usually around 8%. Okay? So at 8%, that means you need to add $1,600 to the rent, which means for them to get their net return on investment they're looking for, they would need to rent the house out for $3,400 a month. That's almost double, watch this, double of what the original rents in that area were costing. So that's the reason why all these houses, 3.7 million of them, just lay vacant. They have no tenants. So what's going to happen? Well, let me explain something a little bit about the IRS tax code for businesses, for hedge funds, for investors. Yes, there's tons of guys who pay almost no tax, but that's on commercial property. A house is not a commercial property. It cannot be converted into a commercial property. So they can only write off, watch this, they can only write off the loss for 2 years, 2 tax years. Not 2 full years, 2 tax years. So if they bought it in November of 2020, that means that their taxes for 2023, for 2022 is the last time they can write it off. Now, that's investors' cash. Now they're going to start borrowing on the money. They're going to look at borrowing options. They're going to look at how they can leverage it, how they can push the envelope leveraging the money. But here's where interest rates come into play. Because interest rates are super high right now, it doesn't make sense for the hedge fund, for the investor, to borrow on the money when they're not getting like 1 or 2%, when they're having to pay 6 to 8%. Now, all their profit, all their write-offs aren't worth it. So what are they going to do? Well, what's going to start is it's going to be called a dump situation. They're going to start dumping properties. And let me explain how that works, because there's going to be times we're going to put on the open market, and there's times we're going to sell it to other hedge funds. Now, here's where I'm going to tell you that this is where it becomes a little interesting. Okay, so let's use the hedge fund as an example. Let's use the investor. We'll call it HFI, hedge fund investors. Okay, so they can sell it to other hedge funds. They could sell it to a bank, and they can sell it wholesale. I'm going to predict, this is where it becomes a prediction. I predict this will be less than 5% of the home sales in America through all these companies that bought them. Okay? What they're really going to do is they're going to hire a company like Zillow, Redfin, and agents. And they're going to sell them between 75 and 80 cents on the dollar. Now, here's the reason why they're going to do this. They know because interest rates, mortgages are skyrocket high. So, for them to sell this stuff with rates high, they have to take a loss. Well, when you take a loss, guess what else they get to do? They get to turn around and take it and write it off on their taxes. So they got the 2-year write-off from not renting the property because they couldn't get the rent income they wanted out of it. Then number 2, they now have to sell it for 75, 80 cents on the dollar for what they paid for it, which is back to what normal appraised value was, just so that way they can write it off on their taxes again. So all it does is it's going to make the company pay less tax to the federal government. So at the end, it's going to save the investors and the company. It saves them money to just sell it back to the people in America. So I predict this will be about 95% of these sales. And I say that's probably going to start happening November of 2023. Because remember, some of these guys started buying these properties, some of these hedge funds were starting to buy properties in 2021. So we still have not gotten to 2023 tax returns yet. So you get to write it off, and I think at the end of the year, as they start seeing their tax bill grow, and they start seeing the rate that they have to pay to borrow the money to keep the property going and release the cash, they're going to be like, screw it. Dump it. Dump all of it. And when you put that much inventory on the market all at once, that's when you start seeing huge supply, very subtle demand, and that's where you start getting these numbers from. So guys, let me tell you, it's very difficult for people to understand that most folks want to ride the wave. So these guys that are 10 millionaires, 5 millionaires, people who made a ton of money with Bitcoin and everything else, these folks are the ones that are going to get the hardest hit by people like me who are telling you this is the way it goes. So if you're worried about prices right now on homes, if you're patient enough, if you can wait 2-3 years, you're going to see a market semi-return to normal.